They may have waited until the bitter end of their prior guided timeline, but Atlas Salt has delivered an updated feasibility study for their flagship Great Atlantic Salt project in Newfoundland. While investors were quick to rejoice on message boards Tuesday morning following the release of the results, we didn't really see any follow through in the equity to match supposed investor sentiment. And that is probably a result of the market needing to digest some proposed changes under the revised plan versus the original methodology. Let's dive in. Atlas Salt has released an updated feasibility study for their flagship asset, which they seem keen to push through to the development stage. The updated study is something we would sooner refer to as a revision rather than an update, however, because rather than just update costs for the 2023 version of the feasibility study, they instead elected to make some major changes. Case in point, average annual production has climbed from 2.5 million tons per annum of sodium chloride to 4 million tons per annum. While at the same time, the overall proposed mine life has been cut from 34 years to 24. Nearly doubling production obviously is going to have some financial impact, at least on the economic side of things. Whereas cutting the life of mine down by 10 years doesn't really have any impact as a result of the nature of discounted cash flows under net present value modeling. The other thing to consider here is that costing has risen, but not as much as you would expect for an operation that goes from 2.5 million tons a year to 4. And that's because under the original modeling, plant infrastructure had been designed for a 4 million ton per year capacity anyways. So really, we're dealing with the cost of inflation here over the last 2 years. Nevertheless, the new feasibility study is said to confirm that Great Atlantic is a large-scale, high-purity, low-cost underground salt project. All right, so let's get into the details here. Atlas Salt, in their revised mine plan, has proposed an underground mining operation that would have an initial life of mine of 24 years, which is based on proven and probable reserves. Annual production is estimated at 4 million tons, with ramp up to that production rate expected to take about 4 years. The mining method being proposed here is room and pillar using continuous miners, with the mine to be accessed via surface portal and conveyor decline system. For those used to precious metals or critical mineral operations, the processing side of the equation here really can't get much simpler. The salt, once mined, will be crushed and screened underground to market specifications, before being taken to surface via a conveyor. After this, it is then transported to the port via a covered conveyor, with this project heavily benefiting from its location, with the proposed mine adjacent to deepwater port facilities on Newfoundland's west coast. And that's pretty well it in terms of processing. There's no sort of heap leaching or specialized extraction operations that are required. The only thing that really needs to be done to the mineral after being mined, aside from being crushed and screened, is for an anti-caking agent to be added right before the mineral is shipped off-site. But what Atlas Salt saves on the processing side of things, they give up ground for on the logistics side of things. This is basically a big earth-moving exercise, in the sense that literally millions of tons of product are to be moved each year, which requires good infrastructure and, in this case, port facilities. Atlas will need to construct a dedicated port storage and ship loading system designed for those 4 million tons of annual throughput, with ship loading expected to consist of a continuous conveyor-fed system. They'll also need to assemble facilities to stockpile approximately 72,000 tons of salt, or about 6 days' worth of production on surface, and they'll need to fork out the cash for the big utility requirements of such an automated operation. Current plans call for 10 megawatts of connected load capacity with a dedicated substation to be installed on site. This side of things is largely unchanged from the prior version of the feasibility study, aside from the obvious changes in production rates and initial life of mine. This leads us to costing, which has changed considerably. Initial capital costs here are estimated at $589 million, which is a 23% bump from the $480 million estimated under the prior feasibility study. The big jump here is attributed to mining, which saw initial costs rise from $152 million to $203 million, while processing costs rose from $39 million to $42 million. On-site and off-site infrastructure costs, which previously were separated into two buckets and estimated at a combined $111 million, has now been amalgamated into surface infrastructure and port facilities, which has grown to costing of $132 million. Owners' costs and indirects moved from $105 million to $134 million, while contingencies increased from $73 million to $77 million. On the sustaining capital side of things, that estimate rose from $600 million to $609 million. As a result, total capital costs over the life of mine have grown from $1.1 billion to $1.2 billion, thanks in part to reclamation and closure costs of $30 million in the prior estimate no longer being factored in under the updated feasibility study. From an operating perspective, life of mine unit costs have fallen from $35.46 per metric ton shipped to $28.17 per metric ton shipped. Now for the economics, which seem to have improved greatly. Under the 2023 feasibility study, with 2.5 million tons of annual production and a mine life of 34 years, the economics suggested that the project contained an after-tax net present value of $553 million, alongside an IRR of 18.5% and a payback period of 4.8, which is based on an 8% discount rate. And under this updated feasibility study, with 4 million tons of annual production and a mine life of 24 years, the after-tax net present value is nearly double the prior figure, coming in at $920 million with an IRR of 21.3% and a payback period of 4.2 years using that same 8% discount rate. Average life of mine post-tax cash flow, meanwhile, improved from $121 million to $188 a year, while average expected annual EBITDA rose from $211 million to $315, which, based on a quick and dirty comparison for investors, sounds outstanding. Yeah, some more material will be moved each year under the current version versus the original, but the payback period is shorter and the MPV has improved materially. So who cares, right? Well, there's some nuance to this. First, in fairness, we'll highlight that the salt price on average over the life of mine is 5% lower in this newer model, dropping from $125 a ton in the older version to $118.50 a ton in this revised version. But that 2023 study also included an expansion case results summary, which envisioned the operation running for 47.5 years at a rate of 4 million tons per day rather than 2.5. And while no after-tax figures were presented, the pre-tax net present value under that model was suggested at $2 billion alongside an IRR of 28%, versus pre-tax figures of $1.7 billion and an IRR of 27% under the current model, meaning it wasn't as lucrative as initially thought. And that there might be the reason why the equity has seemingly fell flat on the report. All right, so let's wrap it up. We should also highlight there's some stuff we left out in terms of differences between the old version and the new version of these feasibility studies. Those are more menial in nature for our purposes and include things like an optimized production plan, port and logistics improvements, and regulatory alignment. As for the next steps here, the project as it stands is said to basically be shovel ready. An environment assessment was completed last year, providing approval to proceed with the project, with the company now required to assemble a capital development plan before receiving commercial production approval. As part of that, the big thing needed from Atlas at this point is for project financing to be approved, followed by detailed engineering and procurement to be undertaken. The study itself didn't mention a specific development timeline. However, that is likely related to their ability to secure funding to move forward. All right, everybody, thanks for watching. As always, if there's stories you want us to cover, please let us know in the comments section. If you want more mining content, check out our website over at thedeepdive.ca. And if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.